Theorem. This theorem is developed by the Franco Modigliani and Merton Miller in 1958. The main idea of this theory is that the capital structure of the company does not affect its overall value of the firm. This theorem is one of the irrelevance theory. Irrelevance theory in the sense capital structure is irrelevant with the maximization of overall value of the firm. So it has two versions. In 1958, they developed without involving the taxes, and after that, in 1963, they developed the theory by involving the corporate taxes. So we'll go with the version 1 without taxes. It is developed in a perfect capital market, where there is no transaction cost and no taxes. The value of the firm and the cost of capital of the company remains unchanged. Remains unchanged in the sense it does not show any effect even though if we change the capital structure. So that is the main concept explained by the Modigliani and Miller. So in traditional theory, what it explained is it is relevant if we change the capital structure, it affects the value of the firm. But Modigliani Miller, what they told is if you change the capital structure, it does not show any effect on the value of the firm. This approach is based on the assumptions. So, first one, capital markets are perfect. All information is freely available and there are no transaction costs. So, another thing is all investors are rational. Firms can be grouped into equivalent risk classes on the basis of their business risk. So the fourth one is non-existence of corporate taxes, as we discussed in this paragraph. In a perfect capital market where there is no transaction cost and no taxes, the value and the cost of capital of the company remains unchanged. So, based on the above assumption, Modigliani Miller derived the following three proportions. First one, total market value of a firm. Total market value of firm is equal to net operating income by cost of overall capital. So, value of the leveraged firm is equal to value of the unleveraged firm. In the sense, so in the traditional theory, what we discussed is if we pull the lever, if you pull the lever in a vehicle, what it affects? So vehicle go faster. So in the sense, by leverage, by involving that portion, you are speeding up your finance in the company. Likewise, even though if you involve the debt, there is no effect will happen in the value of the firm. That is what in the Modigliani and Miller approach they are explaining. So it is nothing but even though if you involve, whether you involve it or not, so it doesn't show any effect. That is why it is mentioned the value of levered firm is equal to value of unlevered firm. There is no effect. So that is what it is explaining. So in the second proportion, a firm having debt, a firm having debt in capital structure has higher cost of equity than the unlevered firm. So if you involve the debt, that is levered firm. If you don't involve the debt, that is unlevered firm. So if firm having debt in capital structure has higher cost of equity than the unlevered firm. The cost of equity will include risk premium for the financial risk. The cost of equity in levered form is determined as under. So this is the formula for the cost of equity in the levered form. So operational justification of a Modigliani and Miller hypothesis. So this operational justification is done by the arbitrage process and substitution of corporate leverage by the personal leverage. So we have to substitute the corporate leverage, corporate tax with the personal, corporate leverage, corporate debt leverage by the personal leverage. So what is arbitrage? Arbitrage refers to buying asset or security at lower price in one market and selling it in another market with the higher price. As a result, equilibrium is attained in different market. Equilibrium will attained in the different market. So to explain this situation properly, we'll take two identical firms which is having debt in capital structure and which don't have the debt. Okay, let us discuss the same in the illustration. Following data is available in respect of two companies having same business risk, capital employed 2 lakhs and EBIT is 30,000 and the cost of equity is 12.5%. Okay, so sources are debt and equity. Leveraged form. Leveraged form in the sense in whichever form it involves debt, then that is the leveraged form. So unleveraged form, no debt involvement. Equity has 2 lakhs. Okay, so investors holding 15% shares in leveraged company, calculate the increase in annual earning investors. Okay, so what we want to discuss about this is a arbitrage process and a substitution of a corporate leverage with the personal leverage. Okay, value of the firm. We have to determine the value of the firm for the both the companies, leveraged company and unleveraged company. So EBIT, EBIT is 30,000. Interest. So we involve debt of 1 lakhs, 10%. So 10% in the sense 10,000. So we have to deduct the 10,000 and we'll get 20,000 in leveraged form and 30,000 in unleveraged form. So these amounts are earnings available to the equity shareholders because we do not have another source in the capital structure, only two sources. So and we don't involve the taxes. There is the assumption is in capital markets there are no corporate taxes and transaction costs. So cost of equity is 12.5% in both cases. So value of the equity is equal to earnings available to the equity shareholders by cost of equity. So total equity, value of equity, that is 1,60,000 in first case and 2,40,000 in second case. So we have to add the value of debt. So in the unlevered form there is no debt. So it comes around 2,60,000 in the levered form. So value of the form in unlevered form is 2,40,000. Just please do observe, value of a leveraged company is more than that of unlevered company. Okay, more than unlevered company. Therefore, investors will sell its shares in leveraged company. So the assumption is we have to sell the shares of leveraged company which is having highest price and buy the shares in the lowest price. Buy the shares in unleveraged company to maintain the level of risk. Okay, he will borrow proportionate amount and invest that amount also in shares of unleveraged company. So the thing is we have to invest in the um, less price shares. So how to invest and how much amount we have to borrow? Selling of the shares in leveraged company. So how much we have to sell? 15%. 15% is the cost of, sorry, 15% shares we hold it in the leveraged company. So we are selling 15% of shares. Those are nothing but 24,000. And in addition to that, so we have 24,000 in our pocket now because we sold it. In addition to that, whatever the portion we sold, that portion we have to borrow. That is nothing but 1 lakh into 15%. Borrow money 15,000 rupees. Buy shares. So those amount we have to buy it. See, to maintain the level of risk, he will borrow proportionate amount. He'll borrow proportionate amount and invest that amount also in shares of unlevered company. So invest that amount also in unlevered company. So 39,000, total 39,000 we have to invest in the unlevered company. So what happens if we invest in the unlevered company? Income from shares in unlevered company. So income portion, how much is the income portion? 12.5. 12.5 is the income portion. So 39,000 into 12.5, that is 4,875 less interest amount. We borrowed 15,000 rupees. So on such amount we have to pay the interest at the rate of 10%. So cost of debt is 10%. 10% interest 1500. Net income from unlevered company is equal to 3,375. Income from levered company, income from levered company is 3,000 if we don't borrow the amount. So income from levered company 24,000 into 12.5 percentage. 12.5% is the cost of equity. So minimum rate of return, that is 12.5 percentage. That is nothing but 3,000 on 24,000. So incremental income due to arbitrage is 375. See, if you do observe, net income, net income from the unlevered firm is 3,375, and income from the levered firm is 3,000. So net income of unlevered firm is more than the levered firm. See, when at the time of calculation of value of the firm, it is observable that value of the levered company is more. Okay, so value of the firm is more in the levered company, but at the time of calculation of income, net income of unlevered firm is more. So incremental income due to arbitrage is 375. So this process will clearly explain about the arbitrage process as well as the substitution of corporate leverage with the personal leverage. So we have to borrow the money, exact the portion where we sells the shares of having highest prices. So 15% of shares we have in leveraged company and we are selling it, that is worth having 24,000, and the same percentage we are borrowing from personal leverage by raising personal leverage, personal debt. So buy shares in unleveraged company. In the sense we are investing in the unleveraged company. So this will be the net income in unleveraged company, and this is the income from the leveraged company if we keep on carrying the same amount. So this amount 375 is the incremental benefit of arbitrage. This is what about the traditional approach. But in the second version, approach, it is amended by the incorporating tax. They recognize the value of the firm will be increased or cost of capital will decrease where corporate tax exists. So what they recognized is if we involve the tax amount, the value of the firm will increase or cost of capital will increase. As a result, there will be some difference in the earnings of equity and debt holders in leveraged and unleveraged form. What will be the difference? See, what this theorem is saying is leveraged form and unleveraged form are equal. It doesn't show any effect if even if we change the capital structure. That is what the theory of Modigliani and Miller. But here also, in 1963, they are telling the same thing. If you involve the tax amount only, the difference amount, the value of leveraged firm will be greater than the value of unleveraged firm by an amount equal to the amount of debt multiplied by the corporate tax. Amount of debt multiplied by the corporate tax. That is only the difference. Modigliani and Miller has developed the formula for computation of cost of capital, cost of equity for the leveraged firm. So, if you do observe, value of the leveraged company is equal to value of unlevered company. So, this is the 1958 theory, same theory. Value of levered company is equal to value of unlevered company. But in 1963, they incorporated tax. So the difference is plus tax benefit. Only the difference is plus tax benefit. Okay. So when value of levered firm is more than the value of unlevered firm. Just now we discussed about the levered company and unlevered company, and this is another illustration. There are two company, N Limited and M Limited, having same earnings before interest and tax EBIT. M Limited is a levered company having debt. The cost of equity of N Limited is 10% and M Limited is 11%. So in this illustration, M Limited is a levered company and N Limited is a unlevered company. So if you do observe, EBIT is 20,000 and 20,000 in the both companies. Debt portion only in the M Limited. There is no debt in the N Limited. Cost of equity is 11.50 and 10%. Cost of debt is 7%. In Unlimited, there is no debt and there is no cost of debt. So value of the firm is equal to value of equity, capital S, plus value of debt. So how to calculate the value of equity? EBIT minus interest by cost of equity. So value of equity, EBIT is 20,000 minus interest 7,000 by cost of equity 11.5%. When it comes to the N Limited, value of debt, sorry, interest is not there because there is no debt. 20,000 minus 0 by 10%, that is 22 lakhs. So value of debt is 0. Here value of debt is 1 lakh. So value of the firm in M Limited is value of equity plus value of debt is equal to 2,13,000, and in N Limited value of equity is 2 lakhs and value of debt is 0. So value of the firm is 2 lakhs. So arbitrage process. If you have 10% shares of M Limited, your value of investment in equity shares is 10% of value of equity. If you have 10% shares, in the sense total value of equity of the firm is 1,13,043 and 10% in the sense 11,304, and return will be 10% on EBIT minus interest EBT. So 10% in the sense 13,000, 1,300. Okay. Alternative strategy will be sell your 10% shares of levered company for 11,304 and again borrow the same percentage of levered firm debt, that is 10% of 1 lakh, that is 10,000. So we have 11,304 plus borrowed amount 10,000, because we have to borrow the same percentage of amount from the personal leverage. So we have to invest both amounts in the unlevered firm. unlevered form in the sense which are having the lowest prices. So total resources available is 21,304. You invest 10% of unlevered firm stock, that is nothing but 20,000. So if you invest 20,000 from 21,000, you are having surplus cash 1304. Okay, forget about the 1304. In the arbitrage process, in the beginning, how much return you got from the levered company? 1300. So after investment in the unlevered firm, so 10% EBIT of unlevered firm, that is 10% of 20,000, that is nothing but 2000 minus interest amount. Interest 7% on 10,000, that is 700. So you will have the same return even if you invest in the unlevered form. That is what the theory is explaining about. So there is no relevance between capital structure and the value of the firm. That is why it is one of the irrelevance theory.